And I'd like to call to the stage our next panel. So dry bulk owners and our moderator. This will be our closing panel of the day and closing panel of Marine Money Week. And a great way to end. And in terms of the smiling faces we've heard about on the part of equity investors, I think a lot of them are have been dry bulk owners in the last couple of years. Krista Volpicelli, Head of Shipping Investment Banking at Citi, will lead the way and bring us home. Thanks, Krista.
Hi, everyone. Thanks for joining for the last panel of the day. My name is Krista Volpicelli. I'm the Global Head of Investment Banking for the shipping sector for Citigroup. I'm delighted to be here with this esteemed panel of management teams across dry bulk companies that have very different business models, which I think will be an interesting discussion. A lot of the other panels up here today have had companies with more consistency, at least I believe. So what I'd like to do, given that, is go down the panel, ask each of you to introduce yourself, what company you're with, but maybe take a little bit longer in your introduction to talk about where your company is focused from an asset strategy. So we have differences in terms of asset focus, large versus small versus ice class. We have differences in asset ownership versus asset light. Cargo versus time charter. So maybe give a flavor for how you view your strategy in the dry bulk market as you introduce your company. And we'll start with you at the end, Costa.
Sure. Thanks very much. My name is Costa Tsoutsoplides, Chief Strategy Officer of Eagle Bulk. Since our inception in 2005, Eagle has been focused exclusively on the mid-size dry bulk vessel segment. And the premise from the beginning and through today, and very much so today, is that the mid-size segment offers the best risk-adjusted TCE returns. We are a ship owner first and foremost, although we do operate third-party ships. We own 53 ships today. We charter in at any given time around 20 ships or so, primarily on a single voyage or two voyages, but we also opportunistically charter in for a longer period as well. We are an operator, meaning we have an active management approach to fleet employment. What that really means is we have a tool of strategies of being able to fix ships, whether it's via time charter, voyage, executing ship cargo arbitrage, chartering third-party ships, and dynamically hedging with FFAs. So we believe and like to think that our business model does create value for the enterprise and shareholders, and I think we've demonstrated our ability to do that.
Good afternoon. My name is John Kartsonas. I'm the managing partner of Breakwave Advisors, which is a fund management firm here in New York, but I'm also sitting on the board of directors for Seanergy Maritime, and that's the hat I'll be wearing today. So Seanergy Maritime is a dry bulk company listed here in the NASDAQ. It operates exclusively on the Capesize segment. We have 17 Capesize ships that operate almost exclusively on the spot market. The firm has grown significantly over the last few years. Last year, we acquired 4 new ships. The previous year, 2 new ships. And we're looking to grow in a reasonable way. in a segment that obviously is one of the most volatile segments in dry bulk shipping, and we think that provides investors with the best exposure when they're looking to invest in dry bulk.
I'm Mark Filanowski from Pangaea Logistics Solutions. Pangaea is a provider of maritime-related transportation services for dry bulk commodities. We do this through ownership of 25 ships and chartering in another 30 or 35 ships a day to operate a total fleet of about 60 ships in niche markets, and a lot of niche markets, and specialty transport. We've always had a focus on trying to do more in our customer supply chains, and that's a real focus of ours right now, providing some stevedoring services for some clients and terminal management for others.
Good afternoon again. I'm Tasos Aslidis. This time I'm the CFO of Eurodry. Eurodry used to be part of Eurosys up until 2018, when we figured that it was better to pursue a segment-focused strategy, and we spun it off. The moment we spun it off, the combined value of Eurus and Eurodry increased by 50%, so we felt that that was the right move to do at the time. We are focused on the middle-size sector of the dry bulk vessels, from Ultramax to Kamsarmax. We have a fleet of 11 vessels, so we're one of the smaller players amongst our public peers. We have built 3 of our vessels ourselves. We have invested in 2 additional modern eco dry bulk carriers, and we have another cluster of 6 Panamaxes built between 2000 and 2005, all built in Japan, and those we consider to be our cash cows with a low-cost capital vessels. And we have the modern vessels that we can carry us into the next decade.
And I'm Hamish Norton with Starbulk Carriers Corp. We own 128 dry bulk ships, roughly evenly divided as between large Cape and Newcastlemax ships, smaller, medium-sized Kamsarmax and Panamax ships, and Supramax and Ultramax ships make up roughly the remaining third. We operate our Capesize and Newcastlemax ships in the CCL pool, primarily on voyage charter, and the remaining ships, Kamsarmax through Supramax, we primarily time charter out, often on single voyage time charters.
COO of Grindrod Shipping Holdings, which is listed on the NASDAQ. The brand that most people are more familiar with in the dry cargo circles is Island View Shipping. We did have tankers as well, but we're purely in dry now. We run a fleet of 15 Handysize and 16 Supra Ultramax, and we've grown that. Island View Shipping originated in South Africa in 1976 as a parcel service operator, and in 1999 was bought by Grindrod Limited in South Africa. And at that stage, they started to go into owning, and we built a fleet of handy-sized ships, which from 2001 were operated by Larretson in the IVS Larretson pool. I joined in 2010 to run the commercial side when Martin Wade was appointed as CEO of the company. And since then, we've focused on growing the Supra Ultra fleet whilst maintaining the handy-size fleet. So on the Super Ultra side, we've grown it to 16 ships long-term time charter. We operate them ourselves. We have various sizable contracts, particularly focusing in the Indian Ocean area. And we focus very much on the relationships with Japanese shipbuilders. And we have a low-age fleet of average 5 years on the Super Ultras and 9 on the Handysize.
Great, thank you. So maybe to start, reflecting on this market, I think it's widely known and acknowledged that the supply side of dry bulk has been in a pretty good state. And that has driven a very good market, and I think most companies here enjoyed a very strong market as we went through 2021. As we got to the first half of 2022 and the world was kind of thrown into turmoil with geopolitical events, with rising inflation, rising interest rates, how has the demand side been, and how have you seen the market over the kind of the first 6 months of the year? And, you know, putting on your crystal ball, with everything that's happening in the world and how trade lanes are changing, demand is changing, what's your view for the balance of 2022? And Tasos, how about you start?
Sure. I think I would like to stress again what you said as well, that the supply side, the order book is very low. It's about between 6.5% and 7% of the fleet. I have been involved with the industry for a good part of the last 30 years, I think actually more, and it has never been as low, the order book. And that sets the premise and the stage for a sustainable market for the dry bulk. Now, the demand side need to be stacked against that, against the low expected supply growth. And indeed, that would depend a lot on what happens in the world. I mean, dry bulk trade is very much correlated, not perfectly, but very much correlated to the world economic growth. So any talk about any possibility of recession, any possibility of lack of growth in China, all of these would affect the demand for dry bulk commodities, and also effects from the war that might change the pattern of trade vis-a-vis the grains and the emergence of the coal, at least for the near term. All of this would need to be weighted against the supply side. So I think I'm personally very optimistic on the dry bulk because of the supply. I think that can absorb in the medium term whatever volatility there comes from the demand side.
Go for it.
I would say that it's never the demand side that's the problem in our business. Maybe shortly, maybe in the short term it is, but over time demand climbs, and worldwide trade supports a demand incline. Strip out the fake demand created by all the confusion and disruption in the market today, I think you'd find a pretty strong physical market. It's the supply side that concerns me. And I guess there's a rumor there's a movie being made about shipping, so watch for it. But to use some shipping or some film titles to describe what my concern is over the supply side, it's like Basic Instinct and Wolf of Wall Street. There are things that we do to ourselves that are the real worry for me. We really can't trust ourselves to stay away from the new building market. And whether it's new orders or finding a place to build a ship somewhere, we're going to do it eventually, and it's going to come back to, another cycle.
But there's no threat of that in the next couple of years, 2 or 3 years.
You're right. There's a runway here that will be good for all of us, but eventually the window will close again.
Hamish, you look like you're ready to say something.
Oh, well, look, I just think that obviously one of the things that's preventing orders is that nobody knows what to order. And, the ship you're pretty sure you will need in 2030, you can't order today. And I think it's actually becoming less and less obvious what one will need in 2030. And, Friday of Posidonia week, we had a guy make an appointment to talk to our technical people about his new tugboat that will tow any size cargo ship at its design speed using only wind and no fuel. And we thought we'd get out the popcorn and, have an interesting, somewhat psychedelic presentation. And in fact, it was really serious and well thought out, and it might work, in which case maybe we need to order ocean-going barges. Really, it's becoming very, very uncertain what we need, and that's holding back orders. That's a good thing.
Yeah, I would maybe just add to that in addition to that uncertainty, we in dry bulk are benefiting from container ships taking all the new building slots through at least 24. So that's very helpful. And also pricing, right? Secondhand tonnage is still trading at a discount to new building. New building Ultramax Chinese, you're looking at 35 million probably for delivery 25. You can buy a 5-year-old at 31. So it still makes sense to buy secondhand, especially given the uncertainty that Hamish is talking about.
Well, I will take a little bit different approach, especially for the last 6 months, as you mentioned, what has happened. And I think, especially for the more dynamic segments like Cape sizes, shipping has been very fortunate because of the unfortunate events in Ukraine. If you were to look at the demand side of shipping in the last 6 months, it's down something 8 or 9% on a ton basis. And in different times, that would be a disaster for dry bulk. But you did have the geopolitical events that affect a lot in terms of inefficiencies, a lot of changing trade patterns. And that, I think, is acting as a bridge between kind of a cyclical downturn demand and what could be a very strong second half of the year on the upcycle on the other side. Because China obviously has been very weak, as everybody reads in the news, and that affects dry bulk as well, because it's the strongest demand center. So if China, which is very likely in the second half of the year, ramps up in terms of economic growth, that would be, again, beneficial for dry bulk. But you would have bridged 6 months of weakness with what happened around the world geopolitically. So I think that has been very good for dry bulk. It's something that won't last because this inefficiency is there to become more efficient. But you're going to have the underlying demand that eventually will bring you up again.
But what if, so Mark mentioned a recession, and increasing fears, increasing percentage of investors are worried about a global recession. So the order book's very low, everybody agrees with that. It's allowed the sector to perform as it has, but what impact would a recession really have? I mean, could it negate all of that, or can the low order book kind of help transcend a global recession?
Well, I think the inefficiencies that are in our industry at the moment will help us against the effects of recession, but certainly in the near term, we do have headwinds which we didn't see 6 months ago pre-Ukraine. We knew inflation was likely to come, and now we know it's here, and that could create probably a V-shaped recession. I would have thought, I would hope. Regarding the last 6 months, been fantastic, and I think for the rest of the year, especially in the geared sector, there are so many inefficiencies there that even if the recession comes, it's not going to hurt us too much over the next few months. As far as the order book is concerned, it's the first time in our lifetime that we haven't built our way out of a bull market yet, and that's because we don't know what to build. And as Hamish said, what do we need in 2030? No one actually knows, and I don't know any ship owners who are gung ho. We've heard of people ordering just to renew their fleet, but no one's going out there to build new fleets and massively expand. And I think that's very hopeful. And in the geared sector, you've got, if you look at the new building, sort of like 2011, 12, 13, it was massive. And a lot of that was Chinese ships, which Chinese build better ships now, but then they're really not great, as you can see by the second-hand values. And they're going to, 26, 27, they're going to hit 15 years old. And they're going to struggle with the EXI. So I'm very hopeful for our sector.
I can add, if I may, all these geopolitical effects that we're talking about add more constraints on how the world trade is being carried out. Assuming that economically you try to find the most efficient solution given a set of constraints, if you add more constraints to the system, it's becoming less economical, which means more ton miles would be needed. So against the fear of the recession, you have to counterweight the possibility, at least in the near term, of this additional trade demand that will be created by the imposed inefficiencies because of the constraints with the grain coming from different sources and coal coming back and the like.
Yeah. And I mean, obviously a recession is not going to be good for our business, but note that as John Kartsonas pointed out, the rates we've had in the first 6 months are rates that were very good and were there despite the fact that China was really weak. And now with the European governments and the American government, tightening monetary policy, we've got China stimulating its economy. And China stimulates its economy in effect by subsidizing steel production, which is the heart of our business. So I think a recession is probably happening, but I don't think it's going to be that bad for us.
Just to add one thing, I think, as you said, when housing starts in China drop 40% in a month, that's a recessionary environment in that part of the world. And I think when you talk about recession and you think about the US or Europe, that's not what dry bulk is driven by. It is Asia. So China's cutting rates is adding stimulus, and you have to look forward. So as you look forward to the second half of the year, all this will start to play out, which effectively is positive for dry bulk. So I think like that period where we had strong rates over the next 6 or 9 months was kind of a bonus for dry bulk. But the real demand, which comes from China, will come through economic stimulus coming from that area.
I hope the Chinese have better luck at providing a safe landing or a takeoff for their economy than I trust our central bankers in doing.
I would just add another point on the supply side, which is going to help out in the near term and medium term, is slow steaming. In the near term, it's because of fuel prices. Medium term, it will be because of these regulations which are coming into effect in 23, 24. That's another factor to consider.
So that's a good transition. Let's talk a bit about environmental changes. And there's, of course, kind of some short-term regulations coming into being that I assume is going to have an effect on the market, especially with older ships. But would love to hear any commentary there. But also, no one knows the fuel of the future. That's impacting ordering. But how are your companies thinking about preparing today for that longer-term transition? So pick either short-term or long-term, whichever you'd like to comment on would be great.
The way we're treating things is both long-term and short-term. It's a multidisciplinary approach, from everything from buying or building the right ships, to operating them well, technically managing them well, and fixing voyages to eliminate efficiencies. It all comes down to economics today, and it comes down to emissions tomorrow. If we save fuel, we're saving emissions. If we're operating at lower costs and maybe making our ships go longer instead of having to be replaced sooner, maybe at the end of the day, that's a better approach. So I think you really have to do think both short-term and long-term.
Well, I mean, what we're focused on is keeping our hull clean. One of the most important things to save fuel is to keep the hull sparkling clean. So that's better paints, that's hull cleaning robots, that's other sorts of anti-fouling technology, and we're putting energy-saving devices on our ships to better set them up for EEXI and the CII regulations. And we are, optimizing our routes and our speeds, by computer, which is also able to save a substantial amount of fuel. And of course, all this is based on measuring the performance of the ships, which we do with sensors on board and software systems on land. So, we're trying to get out pretty far ahead of this. And basically try to go beyond compliance.
The thing is that all of these are things that we would do anyway, trying to optimize our operations. And the truth of the matter is that you cannot do much on the existing ships. You can try to keep the hulls as clean, as spotless as you say, but you can get some marginal improvement against your emissions. I think really the way the regulations will be implemented is important, because we don't know exactly what will be if you classify it on certain of these categories. And I think really the next generation of ships is what will make the big difference.
Well, I mean, the next generation of ships, whatever those may be, will make a big difference. But I mean, frankly, the amount of power you can save by keeping your hull sparkling clean is astonishingly large sometimes. and I think it's going to be very important.
I think that can depend quite a lot on what trades you're in. I mean, if you're trading to areas that are congested, then you're going to be challenged by keeping your hull clean, no matter how good the paint is. And every time you have to clean that hull, you take off some paint. For me, the really important thing regarding that is, obviously, you keep on finding the better products, but dry dock your ship every 2.5 years. We charter long-term ships, and occasionally we've come across a situation where the owner only wants to dry dock every 5 years, and 2.5 years he'll do a U-will. That doesn't work for our trades. We go to places like New Zealand, Australia all the time. The hull gets inspected, and it have to be cleaned. And every time it's cleaned, you lose more paint, and you end up in a vicious circle. Likewise, we follow all the measures that we possibly can. But at the end of the day, we're not Formula One. We're waiting for the big guys and the really clever guys to tell us what to do next, and we'll follow it, and we'll make it work on our fleet.
I agree. It's companies with ships of more than 120 in their fleet that should make the big moves.
Pressure, Hamish, pressure.
I think like technology is a necessity, as it's in everybody's daily life today. This is not an option for shipping either. And I think that technology goes one-to-one with the environmental concerns, because you have to use technology in order to improve efficiencies, optimize voyages, and the charters demand it anymore. I mean, it's not that you have the option of not going that way. You have to do it, and you have to listen to your charterers and, of course, your competitors. So it's something that we have been implementing for the last 5 years. We do tryouts with our charterers. We, of course, installed energy-saving devices. 3 years ago, we were talking about scrubbers. The charterers wanted it. We did that. So you have to be working with your charterers in order to implement these new technologies.
So on that point, John, and Hamish, you mentioned this a bit as well in terms of sensors and monitoring and cleaning robots. Is it a differentiating factor in terms of how companies can use technology, software? There was a panel earlier in the conference around some of these emerging technologies. So how are you figuring out what technologies and software to use? Are you working with some of these emerging companies? Are you developing things in-house? Is this going to be an advantage for individual companies in the dry bulk sector, or is it just something that everybody has to adopt?
I think it's true that nowadays there's a lot more in terms of tools and technology that affect shipping, and we all of us used gradually in the beginning, and hopefully that would make a bigger impact, and has made a bigger impact. I think looking back, if I look back in my student years, weather routing was a big thing, right? I mean, when you did that significantly improves fuel consumption. I mean, we're doing it a lot more sophisticated ways now, but that's a perfect example. And there's preventive maintenance measures that we can take, installing sensors on the engines and knowing well in advance what problems you might face. But compared to how slow technology was moving over the last 20, 30 years, lately there has been a lot more options and ideas that are being cultured. Using big data, amongst other things. I remember when I was working at Microsoft, we were collecting data a month after the event from 1 million of sources and spending a lot of money. Now you can get a snapshot of the world trade using information about where every ship is and where it comes and where it goes. All of this has a positive income on shipping and improving the efficiency of the operations.
I think the products are all out there. You've got to pick the right one, and we do, sort of like have collaboration with other owners and see what's working for them, and we'll obviously pursue that. I mean, for example, we're using a system called Podium, which is now real-time weather analysis, and it can also see 10 days ahead. So when you're off on your heading, you sort of like work out which is the best, most efficient way, and then they monitor it in real time. We're also going to be moving towards electronic logbooks, which will help onshore company with their software make sure that everything on board the ship is being done really efficiently. And of course, we've got to try and educate the crew to do their best in that regard as well.
One thing I want to say is that there is an actual dollar number on all these improvements. And I give you a great example. One of our ships came off charter recently, and the charter asked for some of these energy-saving devices and some new technologies to be installed, and immediately the next charter was rated higher than the previous one. So of course you have to calculate what is the expense for that and what the return on this investment is. But if you do this calculation, it's significant. So there is a dollar amount applied to all this. So this is not an imaginary good for the world thing. It actually makes more money.
I agree with Carl that it's really hard to pick what software or data or hardware is going to work for you in your trade. So what we've done is we've invested a little bit of money in a startup kind of fund. It's not really just startup, it's bringing things to market. So we can get a little more direct view as to some products that actually are in use and working. We can make a little decision, get a little inside knowledge on whether it can work for us or not. And if it's successful, great, we'll use it, and hopefully everybody else will too. And it turns out to be a good investment, but at least it gives us a different view into what works and what might not.
I would just comment on Eagle. 5 years ago, we developed an in-house vessel performance department, and that department now has grown to a few individuals, and the value that that department creates is very tangible and real, and as John says, you can measure it. And it's through data analytics and analyzing and directing the ships to go faster or slower, et cetera, basis the market on a real-time basis has real value. On top of that, as Tasos mentioned, we're doing things as we would normally do, but we've engaged in a pretty significant fleet renewal over the past 5-6 years, where we've sold 20 of our oldest, smallest, least efficient ships, acquired younger, more modern ships, and that alone has probably improved our fleet fuel efficiency profile by 15%. So it's pretty meaningful.
Great. No other comments on technology side. So if you think about investments that you may want to make in terms of staying competitive, thinking about the environment that we're in, retaining flexibility, how have your financial policies adapted and changed over the past couple of years? As you're focused on capital allocation, what are some key priorities for each of your companies?
I guess I'll start. We executed a comprehensive refinancing in October of last year, where we pushed out our bank debt maturity out to 26. And this was on the back of a recovering strong market. Priority number one right now is to maintain a conservative balance sheet. Our leverage is probably in the low 20% range, and continue to delever. Also, we enacted a capital allocation strategy, putting in place a 30% dividend program in place, where we've now paid out 3 quarters. We also have a share buyback program in place as well. So it's really about execution at this point, and just continue to delever, strengthen the balance sheet, and reward shareholders at the same time.
Let's go right down the line. John?
So I would agree. I mean, in an upcycle, these are the 3 things you do. You delever, and you return capital to shareholders through dividends and buybacks, and these are the 3 things we've done as well. At the same time, I think as you look at the dry bulk over the next few years, and you do the return calculations, it is still a very profitable business to invest. So we still maintain some firepower to invest, and we have grown, as I said at the beginning, last year, this year as well. And again, you don't do it at any price, but still, if you look at the forward curves, if you look at the asset prices, we're still in a very decent return territory.
We all take tremendous risks in the market when we operate our businesses. So we think it's very important to be conservative with your balance sheet. We always have been, and it's what's seen us through a lot of bad markets. All that being said, we started to, as we started to accumulate cash in this current market, we started a dividend, and we've increased it. It's now paying what we consider to be meaningful and sustainable. I think that's the key, sustainable dividend for us. for our dividend, for our shareholders. It's, I think, today paying 7.5% or something like that. But I think when we look at capital allocation, we want to have a sustainable company, not one that can keep reinvesting some money in its business, because that's where the best investment is. It's in your own business.
Because of our size, we have, as I mentioned, 11 ships. The name of the game for us is flexibility. So we focus our investments in the middle of the size sectors, on the most flexible ships that still provide certain economies of scale, like Ultramaxes, Supramaxes, Panamax, and Kamsarmaxes. And within that space, we have a two-pronged strategy. We have a cluster with low-cost elder units built in early 2000s, and then a cluster of what we consider eco and modern units. As I mentioned in the beginning, 3 of those we built ourselves. And that way, we believe we can optimize the earnings for our shareholders. The older vessels are cash cows, and the newer vessels provide us the power to remain in the sector. At the same time, we have taken the opportunity of the strong market to delever the balance sheet. We're 35% loan-to-value ratio at this point, and I think that makes us feel good. We have increased our fleet by about 40% over the last 12 months, about 3 units, I guess. And that way, we are about to continue our accumulation and consider potentially instituting dividends and possibly share buybacks.
So we have prioritized delevering and returning capital to shareholders through a dividend policy. Our debt is now, net debt is below about 30% of asset value. We've paid something like $5.60 of dividends in the last 4 quarters. That's under a dividend policy which forces us to retain $2.1 million per ship, and we basically pay out the cash flow in excess of that. At the same time, we basically plan to use our equity to increase our fleet. We've almost doubled our fleet in the last 3 years through 8 small M&A transactions using our shares. It was 58 ships we added. And you know, we would hope to be able to do similar transactions or otherwise use our equity in an attractive way to build the fleet. You know, we think that over time, shareholders will appreciate this to an increasing extent.
I think shipping's great, isn't it? We've gone from how to survive 2 years ago to how to spend it. We've got 7 long-term time charter ships, which 5 have purchase options. So that's the immediate aim for the cash that's been generated. And we also will deleverage. We have a policy of share buybacks in the dips, and obviously returning capital to shareholders.
Great, thank you. With the 3 minutes that we have left, would love to hear what metrics would you guide investors to think about? So for those who are, you know, may not be invested today, or maybe they are, they're trying to think about, you know, do they invest more? What are the 1 or 2 metrics that you would advise investors to look towards as a signal that things could be getting even better, whether it's data out of China, whether it's global GDP, but what are the metrics investors should be watching? Maybe take 30 seconds each.
Sure, I'll start. I mean, at a macro level, you know, everyone is expecting a recession to take place, and you know, the question is, how big of a recession will it be, right? It could be a moderate recession, and I think, again, speaking on a macro level, I think that could be really positive for the markets, and that, of course, will be good for aggregate demand and dry bulk demand. But I think going to John's point, it's about China, and you know, the stimulus that they will put into place over the next 6 months and coming back online is really probably the main driver.
Yeah, so as I said, we're transitioning from, you know, what has happened in Ukraine and all the inefficiencies in the world to more of a demand-driven market coming from Asia. So I would definitely focus on, you know, the news out of China, which usually are buried under news coming from the Western world. But things like traffic in the streets of Shanghai, of course, all the macroeconomic announcements, weekly steel production numbers, things like that that are more real time, and that would provide some insight whether the stimulus is working and how much is working.
We're not directly exposed to China very much. Most of our business is Atlantic Basin, but of course, whatever China does makes every ship rise and fall, right? So we're mostly looking at infrastructure stuff, a lot of aggregate moving. There's an aggregate shortage actually in some parts of the U.S., in the Gulf Coast especially. We're transporting a lot of cement into the U.S. right now. And when cement comes in, you probably see steel follow. So I'd look and see how this infrastructure thing is building up and then going to be built out. And of course, keep an eye on the supply.
I think it has been said very well, but I will summarize it with two words. I think China is the health of Chinese economy, and the order book are the two factors that I would look to decide whether dry bulk is a good investment or not. And so far, at least half of them are lining up well.
Yeah, I would say that anybody who doesn't own our stock is just missing the dividend. And looking for a trigger is a fool's errand.
I think you've got to take the longer term view at the moment. I mean, in the near term, we do have these inflationary pressures. But longer term, I would look at the supply side. China will be okay long term. You've got the stimulus measures in the States. You're going to have a little bit of a Europe, US versus China, competing with the Belt and Road policy. So I think all these things are good for shipping. But yes, you have to keep an eye on the supply side.
So we are exactly on time. Thank you for all of your participation and insights. It was a great and lively discussion, and thanks to Marine Money. I think, Matt, you're coming up to...
Photo?